Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday? And that question I always like to ask is, what in life should you want to control? Now, I would say there's three main things that we want to control in life. There's lots of things we want to control, but there's three things, especially when it comes to this presentation and this concept, that we want to control. So the first thing a lot of people think of that we want to control in life is money. Because money is just a tool, by the way, but it allows us to do things or have experiences in life that we want to have. So money is just a tool, but a lot of people think, hey, that's what I want to control. Well, another thing that a lot of people say that we want to control is going to be time. So for me, by the way, time is that one thing that I love to control above all else. Because if I can control my time, and by the way, I used to work in corporate America, all that kind of stuff, but when I can control my time, I'm happier, I can do more things, but I can also control money too, but I have to control money first. So controlling my money is what has allowed me to control time. But the thing that I had to really focus on first, which a lot of people don't really think about, is of course your mindset. What goes on up here? Because what goes on up here is so extremely important, because if you don't control your mind, by the way, somebody else will. And that's why a lot of people find themselves in a situation where money and time is being controlled by somebody else. And that was me for a long period of my life. So those are the three things. Now, as we go through this presentation, I am going to be challenging mindset. Mindset is that one thing that we have to really look at when it comes to money, and also, of course, the concept we're going to be talking about in this presentation, which is the infinite banking concept. Now, I want to share this quote real quick by Will Rogers that we like here at the BYOB team. The problem in America isn't so much what people don't know, it's what people think they know that just isn't so. So just kind of keep that in mind. I want you to think about this. If you took 100 18-year-old kids and put them in a room and asked all of them, hey, how many of you want to be successful, or where do you want to be at the age of retirement? Well, they're all going to say, I want to be wealthy, I want to be rich, I want to be happy, all that kind of stuff. But unfortunately, when they get to the age of retirement, of those 100 18-year-old kids at the age of 65, let's say, only maybe five out of 100 of them, 5% are going to be financially secure at the age of retirement. So what we're talking about here today is, how do we make sure that we're going to be one of those 5%, not the 95% that are, financially challenged at the age of retirement. We want to be financially secure or even financially free at that point. All right, so a little bit about me real quick. Obviously, my name is Brian Fouts, that you don't know. But yeah, I went to college, did that whole path, right? The whole, I call it the hard way. I was raised lower income. I was never taught about money, that kind of stuff. That traditional path, that's what I was told to follow. Go to school, get good grades, all that kind of stuff. Go into corporate America, which is exactly what I did in construction. I had a 401k. I had, the house, the family, all the debt that came along with that, right? I had the car loans, all the kind of stuff. And I was told I had the American dream. For me, felt like the American nightmare, because I was not happy. I was drowning in debt. And then I found out, and I did this math here at one point after reading an article in a magazine about millionaires. And I went home and I found out what my net worth was. And it was a negative number. After 10 years in corporate America, I was worth a negative amount of money, which kind of blew me away. How can I ever retire if I'm going to be worth nothing? And the math did not look good every year thereafter, because it actually got worse. And I was like, what the heck is going on? So I decided to make a change. And my grandfather, right before he passed away, he did not get to live into retirement, by the way. He didn't get to enjoy retirement. But he told me one thing. He said, live your life now, don't wait. And that kind of set me off. And it took me quite a few years to get out of corporate America and get into investing and all that kind of stuff. I bought businesses, I built businesses, I lost businesses, but I had a lot of experiences. And this is one of my businesses back in this is actually during COVID 2021. It did about a little over 2 million in revenue, which was cool. But I never thought that was possible. But this concept we're going to be talking about today was the main cornerstone of how I built that business right there. And so I've really experienced a lot of things in my life. I've had a lot of experiences because remember I said I like to control time. I love to have experiences. That's my big thing. Money, yay, not really my big thing. I like to control my time so I can have experiences. So my family and I have done a lot of cool things in our lives since we decided to make a big change. And so today I spend a lot of time talking about this concept, sharing this concept with other people, speaking on stages, doing live events like this, just to share how this concept does work because it's what I focus on in my life as well. So that being said, what I want to share with you right now is this. So this concept, the infinite banking concept, is not something new. It's been around for a long time, and you may have come across it before and not known what it was. By the way, that was me. There's a book called Second Chance by Robert Kiyosaki, the author of Rich Dad Poor Dad. He talks about this concept in his book Second Chance. And when I read that book, I read about it, but I didn't really grasp what it was. Fast forward though, I actually started working with a lot of Robert Kiyosaki's personal advisors, Ken and all those guys. And one of them, Patrick became my mentor in infinite banking. So that whole group uses this concept. Tony Robbins talks about it in his book, Money Master the Game. So that was another time where I came across it, but didn't really understand what they were talking about. But now I'm like, oh, it was talking about infinite banking. Then, of course, there is the cornerstone, the book, Becoming Your Own Banker, by R. Nelson Nash. He's the one that popularized this concept for as we know it today. So I recommend definitely these three books. Definitely recommend reading those ones. They're really good for especially for mindset. And then, of course, you've got my friends and mentors, Brent Kessler and Chris Naugle. They have a book called Mapping Out the Millionaire Mystery. And then Chris also has the Private Money Guide as well. You got to understand this concept, as I said, is not new. It's been around for a long time. So you got to understand because it's been around for a long time. Of course, other people are using this in very unique ways, and there's a lot of big names that use this. So Jim Harbaugh, he was at one point college football's top paid coach, but he was paid through cash value life insurance. So the infinite banking concept, that's how they paid him. And I won't share why they did it, but bottom line, the college is going to get all their money back, plus probably multiply it times three down the road. So there's reasons why they do it. Now, this gentleman here, you may have heard about him before. You may not. You may have forgot about him. His name is Joe Biden, or President Biden. So he has, I think, 6 policies with one company. So he uses this concept. He and his wife have been doing it for obviously a long time. Walt Disney. So Walt Disney could not get Disneyland started because he couldn't get bank financing. No bank would give him money. So he actually had infinite banking in place. So he ended up going to his own bank, his own policy, borrowing the money to start Disneyland. So we might not have Disneyland as we know it today without this concept. Kind of cool. Ray Kroc, the McDonald's story about how he took it over. But he actually, when he was expanding McDonald's, he had no money. So he used his policy, his infinite banking strategy to fund the growth of McDonald's when they were growing it back in the 50s and 60s. Pampered Chef, she did the same thing, used some money from a policy to start Pampered Chef. Of course, now it's a $1 billion company. And then lots and lots of wealthy families have been doing this for a long time. The JPs, Morgans, Chases, Vanderbilts, Rockefellers. I've even personally had the conversations with at least one billionaire and some other people that are very high net worth, and they shared how they do infinite banking in their lives. It was just so cool to talk to them. But yeah, I mean, they've been doing this for a long time. Now, why do we want to do infinite banking? Why would we want to be our own bank? So here's some things that infinite banking does for you. And I want you to make sure you understand what these are. So one, it creates a guaranteed tax-free, by the way, generational wealth day one. It allows your money to grow uninterrupted, which means it never goes down. It always goes up no matter what you do. Borrow money, use it. Your policy will still grow uninterrupted for the rest of your life with guarantees, by the way. It takes the control of your money away from the banks because when you give money to the banks, they actually control your money. They own it. They put it to work, as I'll show you in a little bit. But when you do this, you're taking control back into your hands, which we want to do. It protects your money. So this is state specific, by the way, but it protects your money. If you're going to work hard for your money and you want that money to be there for the rest of your life, you want to protect it as well. If it's in the bank, if it's in 401ks, it's not protected. So by the way, it is protected in this concept. And then, of course, the big thing it does, it allows you to be the bank for things that you may normally use a bank for. So think of things like buying a car, right? College, homes, real estate investing, retirements, all that kind of stuff. But here's the cool thing. It does that and all of these things at the exact same time, not one or the other. Take your money, put it to a 401k. It's in one spot. It's only doing one thing for you, hopefully going up, but it will go down sometimes. This does all of these things at the exact same time. All right. So who wants to have these things in their life at the exact same time? I mean, do you think that's going to help you grow your money? One real quick thing. I'm going to go through this one pretty quick, but when it comes to mindset, we've got to understand that the way we've been taught about money for our entire lives might not be the real way that money really works. So there's a thing called the backwards bicycle. You can go watch it after this, but it's kind of an analogy. So if you go watch the video, when that guy hops on this bike, he has been taught how to ride a regular bicycle. But this one operates the exact opposite. When you turn the handlebars to the left, tire goes to the right. And so he falls over, he can't ride the bike, all that kind of stuff. Kind of the same thing about money, right? When we start to learn how money really works behind the scenes, it's kind of hard to grasp at first. But the thing is once he learns how to ride the backwards bicycle, he can ride it, right? Yet here's the thing. What happened when he got onto a regular bicycle? He can't ride that one anymore. So as we go through this presentation, keep an open mind, because when you learn how money really works, sometimes it's very hard to go back to the regular way of thinking about money that we've been taught for our entire lives. All right, so some quick things that you got to understand that, why aren't more people successful? Because there are things that hold us back. So wealth killers, what kills wealth? Taxes, inflation or inflating of the money supply, volatility, interest, of course. Then, of course, also mindset, following that status quo, fear of missing out, life in general, and then what we're taught. All of these things hold us back from being successful. So as we go through this, keep these things in mind. Now, real quick, what's the definition of money? As we're going to talk about it here today, it's just a means of exchange. That's it. What company uses compound interest? Because we're going to be talking about compound interest. Well, no company really uses compound interest. They want to earn it, but they don't really use it. Are your dollars worth more today or in the future? Your money is always going to be worth more today than it is down the road. So that means we want to use our dollars today and for our entire lives, not put them into like a 401k as an example, and then use them down the road. Because will taxes go up or down? Of course, they're going to go up. They typically do not go down. So we're going to pay more taxes down the road. So that means, would you rather pay taxes today or down the road? I'd rather pay taxes today and then hold on to all the dollars in the future. All right. Because here's the thing. Would you wait to eat bread or drink milk? Now, why am I asking that question? Because a lot of us, when we put our money into some sort of, retirement vehicle, we're not going to use it today. We're not going to eat the bread right now. We're going to wait till, 30 years down the road to eat it. Because here's the thing. When you think about a retirement account, what you're really doing is you're kind of delaying the gratification of being able to use that money. Also, who controls it? Well, the IRS controls it. Wall Street controls it. You don't really control that money if it's in a traditional retirement account. So I want to control, and we want to control our money today, tomorrow, and for the rest of our lives, while still having all the growth that we need for down the road as well. So there you go. Now, what I want to do really quickly, I want to share how a banking transaction works, but I want to kind of put a spin on it a little bit. So let's just use a typical transaction of buying a car, because most of us have bought a car before, right? So let's just say that we have $25,000 in a bank, and we're going to go take that money out of the bank and go buy the car with cash. Okay. And let's say that we've been saving, for years. Every month we take a bit of money out of our paycheck and put it into the bank for that cash. But what if this happened? What if you go to the bank to do this and the banker goes, "Hey, Brian, rather than giving you the cash, what if I do this? What if I keep your money in the bank and I give you 4%, but I give you a loan of $25,000? So what they're doing is the banker's saying this. He goes, "I'll keep the cash. I'll give you 4% on that money, and I'll give you a loan with the cash as the collateral. And then you can go buy the car with that loan. But let's say that loan is 6% at 60 months. So wait a second. So I'm going to earn 4% on that money, but you're going to give me a loan for 6% for 5 years. Yes. Does that make sense? Well, math is math. Let's look at it. Monthly payments on the car loan, $483. Future value of that money is $29,000 or $28,999. Okay. But what's the value of the money in the bank that's earning 4%? Not 6, but earning 4%. The future value of that is $30,525, which means you have made $1,526. How is that possible? Well, you're paying 6% on a decreasing loan. You're earning 4% on an increasing balance. It's just math. So in this scenario, it does make sense that you'd want to go get the loan in that scenario. But then the question is this. Well, Brian, but if I had paid cash, I wouldn't have any payments. Yes. But how did you save up the $25,000? Well, the typical answer is I saved it up every month. I've been taking money out and saving it. Okay. So if you take the cash out and buy the car, are you going to continue saving money into your savings account? Yes. Well, then this cash flow is exactly the same, except you made money doing it this way. So that's a good example of how, when you think about being the bank, you can do this. Now that we know that, here's the three things we're going to be covering here today. So one is the machine. What is the machine that makes this function? Then, of course, we got the marathon, right? So building wealth is not a sprint, it's a marathon. We're going to talk about how that works. And then, of course, the millionaire method, because what's the whole purpose of this eventually is to build wealth. So let's look at the machine. So what is the machine? So I want you to think about this. I want you to think of infinite banking like a car. Okay, it's got wheels, tires, brakes, radio, hopefully the steering wheel, windshield, all that kind of stuff. But if that car, which is infinite banking, doesn't have an engine, can it go down the road? The answer is no, it can't. So what I want to share with you is what is the engine that allows the infinite banking strategy to exist, or the car to actually go down the road? It's nothing more than a specially designed, by the way, dividend paying permanent whole life insurance policy from a mutual insurance company. Now, there's not every company can do these, by the way. There's only a select companies that can do infinite banking. Now, you might be saying, well, Brian, why would we want to use a banking policy for this? Why would I want to use this? And hey, Brian, would I use an IUL or a VUL or a whole life? Because I mentioned whole life. Well, let me explain something to you. Guess who the biggest buyers are of infinite banking policies? It's banks, by the way. So traditional banks, like big banks you see on the corner, in downtown, they own more whole life insurance than they do their real estate and buildings combined. And they don't buy IULs, they don't buy VULs, they buy whole life insurance policies, and they own a lot of that, by the way. So if big banks are doing this, we're going to bypass by not giving them our money, and we're going to go do what they're doing with our money in the first place, which is infinite banking. All right. So I already explained that we can make money earning 4% while paying 6%. So we went through that example already. So just understand once again that this is what banks do, by the way. So we're going to bypass the banks and do exactly what they do with our money. Okay. So, but first, I want to explain how banks function. With what do they do with our money? When we go and give them our money, they don't just sit on it. So let's just use $100,000 as an example. You give it to a bank, and let's say the bank is very nice, and they're going to give us 4% on that money. Okay, that's a liability to the bank because they owe you that money and 4%. But do they just sit on that money? Of course not. They don't do that. They put it into motion, because money in motion makes money. So let's say they loan it out on maybe a 7-year ARM home mortgage, something like that at 7%. What does the seller that got that money do? It goes right back into a bank again. But once again, they don't sit on it. Maybe they loan it back out on a car loan. But what's the dealer do? Puts it right back into a bank typically. What's the bank do? Right back out the door again, maybe on a home remodel, something like that. What's the contractor do? Goes right back into the bank. So you kind of get this cycle. Maybe the next thing is a debt consolidation loan. So the purpose of what the bank is doing with your money is to make money. So what are they doing? They're putting it into motion to the point where they make 500% more on your money than they're paying you. Just math, by the way. And they have to disclose this. So you can go to bauerfinancial.com and you can look up how much banks make on the money that you leave there, between 400 and 1,300%. Pretty crazy. That's a lot of money they make. So once again, being the bank can make a lot of sense. Now, what I want to share here real quick is just what happens when our money comes into our hands, because typically when our money comes into our hands, we pay other people first. So I want to look at the annual pattern of spending, just as an example to kind of get your mindset in the right place. So of every dollar that comes in, it goes somewhere. So 20 cents of every dollar goes out to automobiles. 30 cents of every dollar goes to housing, mortgage, rent, things like that. 40 cents of every dollar goes to everything else: food, clothing, entertainment, things like that. So 90 cents, that's 90 cents right there, of every dollar that comes into our hands typically goes right back out the door again. And maybe we're saving 10%. So what would happen if we were able to recapture a lot of that interest that's going out to auto, housing, everything else? Let's look at it. Let's start with a saving. Let's say it's 10%. Now, of the 20 cents that goes out to automobiles, 5 cents of that is interest. What if we recaptured it back into our hands? Our savings would go up. What about housing? Well, around 25 cents of the 30 cents goes out the door to interest. What if we recaptured that back? Okay, back in our hands. And then everything else, maybe let's say 5% of that it goes out to maybe credit card interest. What if we recaptured that? So you can start to see what happens when you are the bank and you can actually recapture interest and grow your money. You can actually build wealth. All right, so I want to go through now another example. Yeah, professional reporters. Yeah, there you go. I want to go through an example of how infinite banking can work for something like buying a car. All right, so let's look at how this would work. All right, so on this page, what you're going to see over here is what is called a policy tabular detail. right over here. And so you're going to see a few things. So first off, you're going to see premium deposits right here. Now we call those deposits. Now in a traditional like car insurance, when you pay a premium, it's just an expense. There's no benefit. With infinite banking, when you make a deposit, there's a benefit. You get what's called cash value that you can use, you can borrow out of the policy to go do other things with. So we call that a deposit. You're going to see over here, you're going to see cash value. Cash value is what we can borrow out of the policy. Okay. And that's what grows uninterrupted via dividends for the rest of your life. Now, the one thing I'm going to mention here, age doesn't matter. It does to an extent when it comes to these things. But people say, well, what if I'm 55 years old or 65 years old? Can I still do this? Yes, you can. There is a limit as to when you can do infinite banking anymore. It's right around age 74, to be honest. But we have a lot of people doing policies on like a spouse or a business partner, someone else that they have insurable interest on. So you can do it on other people as well. Death benefit. So when a lot of people think about life insurance, they're like, oh my gosh, death benefit is the focus. No, the death benefit, of course, when like term insurance, that's the only benefit there. With infinite banking, we're going to focus on the living benefits, which is not the death benefit. Yes, there is one, but it's not what we focus on. Okay. So let's go ahead and look at an example of this car. Now, in this example, we're going to have someone's going to put in, let's just say $10,000 per year as a premium deposit. Now, you don't have to do 10,000. You can do 15. You can do 5. It depends on your age and all these kind of things, which we'll get into in a little bit. But this is just an example. And this is a very, very ultra conservative example to make a point. So every time this person puts in that $10,000, they're going to build cash value, which is going to compound and grow faster and faster and faster the longer this policy is in place. Now, here's the cool thing. This person says, hey, at the end of year 3, I'm going to go borrow $25,000 out of the policy and I'm going to go buy a car. So they go and get a loan. It's a guaranteed loan, by the way, and they buy that car. But this person's going to be a responsible banker. They're going to pay their bank back with interest. So they're going to pay back that loan. Let's just say it's $500 per month, 5 years, $6,000 per year. Okay. So what's the math on this? So at the end of 7 years, they have put in $70,000 and they've also paid back a $30,000 loan. Okay, that's $100,000. But they've also taken out $25,000 as cash, which they could go gamble that if they wanted to. Doesn't matter. We're going to use a car as an example. So in reality, they have put in $75,000 into this infinite banking policy. But get this, they have $67,000 of cash value, which means they have recaptured 91 cents of every dollar. Now, this is where it gets very, very powerful. Now, by the way, this example is very conservative. Typically, they'd have a lot more access to capital after 7 years, but once again, being conservative here. Now, this person in years 8 through 12 said, hey, what if I don't want to fund my policy anymore? Maybe I want to go start a second policy. Well, they don't have to put in any more deposits into the policy. That's an option, by the way. They don't have to. I would recommend it, of course, but once again, I want to show you the power of how these things work when that compounding starts to come into play. So let's just say that year 8, they are going to go buy another car. My daughter is going to turn 16 next year. God help me. So she's going to want a car. So as an example, we go buy another car for, let's just say $25,000. That's a guaranteed loan, by the way, private loan. And they're going to pay yourself back just like you did the first time. $6,000 per year, $500 per month. At the end of year 12, you've put in $30,000 via the loan. Okay. But you've also taken $25,000 back out of the policy, which means you put in $5,000 in years 8 through 12. But guess what? Between years 7 and year 12, that cash value, because of the dividends and the compounding, has grown by $23,592, but you only put in $5,000. Pretty crazy. Now, one last thing I'll mention that really kind of, I think is paints the picture really well here is how much money has this person put into this infinite banking policy in these 12 years? Well, 75,000 years 1 through 7 and 5,000 in the following years, that's $80,000. But how much do they have access to? $91,473. So they have access to more than they put in, and that'll just get bigger and bigger every year thereafter. And they own 2 cars outright. But their net worth, their wealth has grown, and they own 2 cars outright. So that is a very simple example of how infinite banking can work for a simple transaction like buying a car. Now, just imagine if they put this into a cash flowing asset, like a piece of real estate or something like that, and made money, their net worth would go up even faster. All right, so there's 3 rules with infinite banking that we always want to follow. So what are those 3 rules? The first one is pay yourself first. We're so used to paying other people first, we want to pay ourselves first. Pay yourself with interest. If you're going to be the bank, treat yourself responsibly, right? Be a responsible banker, pay yourself with interest, and then recycle and recapture your money. What that means is if you have an infinite banking policy, use it. put it to work in your life, and then cycle your money back through that policy. So this works for a car. What else does this work for? Well, when it comes to building wealth, there's two things I look at doing. Very simply, right? There's, of course, a lot more into it, but let's just look at two things if you want to build wealth. One is get rid of bad debt and put your money to work. So the first thing is obviously getting rid of bad debt and getting rid of the things that suck money away from you, which is, by the way, debt. So this example, we're going to look at how you can use infinite banking to pay off debts extremely fast and recapture that money back through your hands. So in this example, this is a 45-year-old doctor, chiropractor. And this is, once again, this is a very conservative example, but I want to make sure that we show you how to do this. So this doctor has $478,000 of debt. Quite a bit, by the way. That equals a payment every month of $5,777, which is almost 70 grand per year. And if this doctor paid all the debts off as scheduled, it would take him 20 years, 19 years to pay off all those debts. So let's look at infinite banking and how this would work here. Okay, so this doctor said, hey, I'm going to create a policy, and did it through, someone like us, and he's going to deposit every year $25,000 into the policy. Now, he's doing an annual premium. You can do monthly, quarterly, annually. You can change that, by the way. But in this example, he's doing $25,000 at the beginning of the policy year. Now, you might be saying, well, I'm going to pause here for a second. You might be saying, well, Brian, where's he getting 25,000? I don't have 25,000. Okay, so in this example, this is what this doctor did. So he was putting money away into other retirement buckets, 401ks, IRAs, things like that. And he didn't like that, but that's the only option that he had. And so what he really did was he said, hey, I don't want to, spend any more out of my pocket. Or have any, cash going out the door again. So he goes, I'm going to take money from that bucket and put it into the infinite banking bucket. So his cash flow did not change. He just changed where it was going. Once again, pay yourself first. He's going to pay himself first through that deposit. So when he deposits that money, within 30 days, he has access to right around $14,863 of cash value. Now, once again, very conservative number. The policies that we do typically have around 20,000 of cash value within right off the bat. But once again, simple example here. So what does he do? Well, he goes to his bank and he borrows out 14,000 and he pays off the Discover's card, the Lowe's card, and the Nordstrom's card. His debt drops, but more importantly, his monthly payment also drops by $448. Now, once again, recycle and recapture your money. So what do? We don't let that 448, go out the door. We capture that money back into our policy to keep growing that. So the cash flow does not change. We recycle that money back into the next debt. So what happens in year two? In year two, 25 goes in. His cash value goes up by $16,571. The payments back to himself also equals $5,374. So in total, he has $21,945 of cash value available. He borrows that back out of his bank and he pays off Nordstrom's, Wells Fargo private loan and part of the BMW loan. So he's recycling his debts into his policies, what he's doing. So he's capturing them back into the policy, which is, by the way, is low interest versus these you can see are high interest, 21%, 10%, 3% there, 7.5%, 9%. He's going into a low interest environment. His monthly payments have now dropped by $1,917. So it's going to accelerate. So in year three, puts in 25, cash value jumps up by 25,000, payments back to himself equals 23,000. So now the total cash that he has available to borrow back out of the policy is 48,545, right? So what's he do at the beginning of year three? Same thing. He borrows that back out, pays off BMW, West Marine, and a big chunk of the condo. His monthly payments have now dropped by $3,677. So he now controls that money. He's going to recapture back into it. Now, I want to pause here for a second before we go into year four. So what has happened so far in that example? Well, in the first 3 years, he's put in $75,000. He's taken out approximately $55,000 of loans. So how much is left in the policy earning dividends? Because remember, these policies grow for the rest of your life because of dividends. So is it $20,000 left in the policy? No, it's not. He actually has still $75,000 in the policy earning dividends. So he's still earning it, even though he's borrowed back out of it. So the policy cash value, that's why it's growing every single year, is because of those dividends. All right, now let's go look at year four. Year four, 25 goes in, cash value jumps up by 26,000. The payments back to himself now are 44,124. So the total cash value available is $70,000. Now he pays off the condo and a big chunk of the house. Now, one thing to keep in mind, his monthly payments do not change because the house and the condo, those are amortized loans. So they don't change when you pay down the balance. So it doesn't change the monthly payment, even though he paid off a big chunk of the condo, not the house, but just the condo. So payments don't change. So in year 5, he puts in another 25. Once again, cash value jumps up by 27,000. Payments back to himself is the same, 44,124. So now he pays off the condo and a big chunk of the house. Now his monthly payments have dropped by 4,556. Now this is kind of cool. So in this example, this doctor, what he did was in year 6, he said, hey, this thing is working really good. I love how this thing is growing, but I want it to grow fast. So what is he going to do? Well, one, he takes the premium for the first policy from $25,000. He drops it down to $10,000. Okay. Now the cash value still goes up by $13,000 more than he put into it. And he starts a second policy. So he's going to start having multiple policies. So the second policy, like the first one, he puts in 25,000. Cash value immediately available is 14,863. So the payments back to himself of the 4,556 that he's recapturing, that's 54,678. So total cash available to him is 82,633. What's he do? He borrows enough to pay off the house, and now all of his debts are cleared out. Now, where do those debts go? Okay, the debts actually went to his policy. So now what's he do? So through year 6 and year 7, he takes the 5,777 number and he pays back the policy loan. So now he pays off that loan, low interest, and at the end of 7 years, he's debt free and he has multiple 6 figures of cash value in the policy that, guess what? He's now going to do the second step that I talked about, which is now putting that money to work to create assets that cash flow, build wealth, do other things with it. And all at the same time, having the growth still there. So that's how this works. Now, if you're saying, well, Brian, that was a lot of math, a lot of numbers, which it can be, by the way. So we do have something called the Vault, BYOBvault.com, that maps out all of this stuff for you. And we'll show you where to do it every month, what debts to pay off first, how much to pay off each debt, maps out the entire thing for you, puts the control into your hands. Also, we do have an implementation team as part of our group that actually works with our clients on an ongoing basis to use the policies correctly, show you how to manage them, how to do things, whatever you want to do with it. So I kind of call that your personal financial blueprint. And that's an ongoing service that we provide. There's no cost to it. And so they're agents just like I am, and they work with you on how to use the policy. Because here's the thing, with infinite banking, you've got to really understand how to use it to be responsible with it. And so we provide you that knowledge and that skill and help you learn how to use this thing. All right, now let's go into the third thing. The third thing is the millionaire method. What if I have no bad debt? What if I don't need a new car? Can I still benefit from privatized banking and being my own banker? The answer is yes, absolutely, because guess what? That's where the fun begins. That's when you start building wealth and building the legacy, all that kind of stuff. So we're going to get into, some ways you can do that. Yeah, so a lot of our clients do a lot of things. So a lot of real estate investors, wholesalers, flippers, buy and holds, commercial properties. I've got clients right now that are using this to remodel some apartment buildings to create more cash flow, mobile homes, which is a great strategy. If you can get into that one, I really want to do more of that. Private funds, lending. So being a bank, lending out to other investors, things like that. Business owners. We have a lot of business owners that use this because if you're in business, like I had a business doing multiple 6, 7 figures, and I should have been taking money off the table through infinite banking. I didn't realize that. I wasn't thinking about it. So yeah, so a lot of business owners use this to take money off the table, build retirement, things like that. We do have some stocks and options traders where they're doing like options. So they'll borrow from the policy to do options and pay themselves back. Startups. So a lot of people creating new businesses and even equipment flipping. Yeah, so there's people that flip like forklifts, things like that. Yeah, so there's lots of different ways to use this. Now, what I want to do is I want to give you an example of how this would look for private lending. All right, so what I'm going to show you right here, this is what's called a tabular detail of an actual policy. So you're going to see a lot of things on this. Let me kind of clarify the columns really quick. So you're going to have your age and year over here, and then you're going to have the contract premium. So this is how much this person is putting in every single year. Over here, you're going to have what's called increase in cash value, total net cash value available. Now, these are all end of year numbers. Keep that in mind, end of year numbers. So these are the main things we look at: net cash value, increase in cash value, and then your contract premiums going in, the deposits there. Of course, you have the death benefit. You can see that over here as well, dividends, other things. Now, you see two net cash values. We tend to look at the dividends over here, which are the non-guaranteed, but that's what they have paid every single year for over 100 years. So these are very accurate numbers. Now, let's look at this. Oh, and one thing real quick. Some people say, well, Brian, wait a second. There's a 150,000 going in year one, but why is it 50 thereafter? So the 50,000 is the premium deposit this person is putting into the policy. The additional $100,000 in year one is what's called a dump in. It's an optional thing where you can put in a large amount in the very beginning. And you can do it more than once if you want to, depends on how we design this thing. But the 100,000 is what's called a dump in, and it adds 90% of that value to the cash value within 30 days. So it makes it very efficient. And also the dividends are now going to be very high because they're being earned on a larger bounce day one. So I'll kind of talk more about that, but that's an optional thing you can do to overfund the policies. All right, so let's look at year 8. So I'm going to go 8 years down the road on this example. In year 8, this person put in, $48,000, but the bank grew by $66,722. So that's pretty cool. So once again, they put in 48,000, it grew by 66, more than they put into it, of course, which means they have a cash on cash return of 37% already. Okay, that's pretty amazing. By the way, they had a positive cash on cash return by year 3 on this policy, which is amazing. So it grew by 37%. So raise of hands, who wants to have a 37% cash on cash return on your money? Well, that's awesome, right? But it gets even better. Now, by the way, this person that we're using here as this example, they were a private lender before they did infinite banking. So when they were private lending the money out to other investors, they were getting a 12% return. So hard money lending, if you know real estate. So they were lending out to short-term projects on buy and hold, or flips. So they were getting a 12% return. But get this, with infinite banking, they're lending that money still out. And so let's just look at an example of how this works. They're lending at 12%. You'll see that here. Okay. They're already getting 37% on the money inside the infinite banking policy. Their bank or the insurance company is going to charge them, let's just say 5%. So now they're making 44% on that money. Keep in mind, they were already private lending money back out the door at 12%, but by doing infinite banking, they're making 44% on that money now. And they did nothing different other than where their money went first. It went through the policy first and then back out to the deals they're doing, and they're making a 44% return. So literally they went from a 12% to 44%. Now you might be saying, well, Brian, but you look at year 8. Well, yeah, because as that compounding comes into play, it gets better and better every year. Now, were they lending at year 1, 2, 3, 4, 5, 6, 7? Yes, they were private lending as well in the prior years, but as this policy grows, the numbers get better and better and better. So there you go. That's an example of private lending. Now, why does infinite banking make sense? Because it's uninterrupted compounding. So no matter what, if they borrowed the money out of the cash value or not, they still earn dividends. They still earn a return, which is crazy. So think about that. Look at this. So in year 2, a 21% cash on cash, access to capital is 121%. Year 10, 54% cash on cash return, 154% access to capital. And you can just look at this. You can see the numbers. These are 5-year increments. They just get better and better and better and better. Okay. That is how uninterrupted compounding works. The longer you have the policy, the better and better it gets. So the Millionaire method. Okay. How do you eat an elephant? It's one bite at a time. So why I kind of say that right there is that with infinite banking, you've got to take those first initial steps to get it going. It's not that hit the easy button and you have, $1 million tomorrow. No, it takes time. You got to build this. But just like the man at the top of the mountain, how did he get there? He started climbing. Same with this. Okay. So make sure you understand that point right there. As I said, this works for debts and expenses, private lending, but vacations, homes, taxes, all that kind of stuff. So I'm going to pause here for the taxes one, because with taxes, like I'm an entrepreneur, so I don't pay taxes out of a paycheck. I don't have a paycheck. So I've got to make sure that I'm saving money though for taxes down the road. So what I do is okay, let's say I save up, let's say it's $10,000. Okay, I'm saving $800 to $900 every month. But guess where that goes? Well, it goes into a policy, or I borrow from my policy. I borrow $10,000. I pay off the tax guy, right? And then I take that $800, $900 that I would save every month, but I'm now paying it back into my policy loan. So my cash flow really is no different. I'm just cycling it differently. And now I got that money in the bank, or in my bank, that's growing, earning dividends. I've got a guaranteed death benefit. It's a private strategy. It's protected. And I'm still paying the tax guy like I was before. It's just I did a different way of flowing my money through my own policy first. So lots of ways to use this. I'm not going to go through this example. Now, you might be saying, well, Brian, okay, so what if I want to invest this money? What if I want to put it to work? How do I do that? Well, we have software. We have something called the gains projector. We're going to be loading this into the vault here soon, I hope, where you can go inside there and you can actually run the numbers on a policy and an investment opportunity, and it will map out the best way to do it, to flow the money, to do loan paybacks, all that kind of stuff, to make it as efficient and as profitable as possible. So we've got a lot of tools for you. So let's kind of keep that in mind. So the vault, BYOBvault.com, you can go check it out. There is a subscription to that one. And we also can work with you one-on-one on that kind of stuff. So kind of the way I look at this with infinite banking is what is that switch or that flip we're trying to make? So a lot of us are the guy on the bottom in this picture on the screen. We are working for our money. Our money controls us, right? And then at the top, you got the guy that has his money working for him. That's the switch right there, is we want to be working not for our money. We want our money to be working for us. And so to me, infinite banking is a great way to get that process started, get your money working for you. By the way, some things that we're going to be covering right now. So we didn't mention death benefit. I'm going to talk about it a bit so you got to understand what that is. I'm going to talk about loans, the policy loans that do not have to be repaid. Now you should, but we're going to talk about them. Okay. The dividends, they grow tax-free, by the way. I don't mind paying taxes, but I'm happier paying a lot less, by the way. Policies, exempt from judgments and liens in most states. So it is a protected asset in most states, not every state. You can also create tax-free income in retirement with infinite banking because the loans don't have to be repaid and are not taxable because loans are not considered income, but you can create income in retirement that is tax-free. All right, let's talk about what the death benefit does. So the death benefit is guaranteed and is tax-free. What that means is you can create generational wealth at day one, but it's an always increasing generational wealth death benefit. So let's look at this example here. Now, this is a 42-year-old female. She's going to put in $20,000 for the first 5 years into this policy. That's her deposits going in. And then after year 5, she's going to drop those down to around $3,000 and change. You can do that. We can show you how to adjust the premiums, that kind of stuff. But look at this. In year 1, she puts in $20,000 and her death benefit is $325,000. Now that's the end of your death benefit. At the beginning, it might be something like $300,000, something like that. But look at year 2. Now it's $364,000. Look at year 5. In year 5, she has put $100,000 into this thing. That death benefit is now $483,000. So it's an always increasing death benefit. Look at year 7. Year 7, she puts in $3,000 into this policy. The cash value jumps up by $7,000 and change. She has access to $113,000 more than she put into this thing, and the death benefit increased by $8,000 in that year. So it's an always increasing thing. So day 1, you're creating guaranteed generational wealth. You're going to turn $1 into $5, $1 into $10 guaranteed. Now, if you understand what I just said, you understand why wealthy families do this. Because, and the Rockefellers have been doing this since the 1800s, by the way, been doing this for over 140 years. They know that they can put their money into this policy. They can use it during the life of that person to create more assets and invest, all that kind of stuff. And then at the end of life, let's say $100,000 has gone in, but that $100,000 is going to turn into $500 or $1 million guaranteed tax-free. So they're multiplying their money every generation. And it just keeps going and going and going. It's pretty crazy. So policy loans, let's talk about that real quick. So policy loans, they are guaranteed, by the way. There is no credit check. There's no approval. Ask and you shall receive. The loans are also private. They do not go on your credit report. They do not show up because they are private. The payments back on those loans, there is no minimum or maximum or required payment on those loans. You choose when and how to pay them back. If you miss a payment, nothing happens. Now think about a car loan. If you have a car loan with a bank, who has the title? You don't have it. The bank does. If you miss a payment, what happens? They take your car. They hold the title. So who really owns that car? With dividend banking, if you borrow from a policy and go buy a car, you own the car. You have the title because you also own the bank. So you are the one in control. All right, something else I want to make sure we cover real quick is how can I fund my banking policy? Well, the premiums can go in monthly, quarterly, annually. Those deposits can go in however you want, and you can change that. There's a range of what you can put in. There's a low and a high end. There's a range of what each person can qualify on based upon age and gross revenue, gross income. So the low end is around 10 times your age per month. The high end, it depends on the individual. Typically, it's going to be around 20% of your gross revenue. So if you make 100,000 per year before taxes, your maximum annual premium is going to be right around $20,000. Divide that by 12 for monthly. So that's the range of what everybody can qualify on based upon age and gross income, and that comes from the insurance company's underwriting guidelines. On top of the premium, can I fund the policy with a large upfront dump-in? Yes, you can do that. So you can put in zero, of course, 1,000, 5, 10, 15, 20, $100,000 into these things to really energize the cash value, because depending on how you fund this thing, you can have access to 50 to 90% of what you put into it within 30 days. Okay. But as I showed you on the other illustration, the longer you have this thing in place, the more you can have access to the point where, hey, guess what? You put in $1, it grows by $3, and it just keeps getting better and better. So let me show you an example of what I mean here. All right, so this is a pretty straightforward policy. This is a 32-year-old female. She's going to put in a $10,000 annualized premium. It could be monthly, etc., but she's going to do annual, and she's going to do a $50,000 lump sum dump in day one. Now, keep in mind, these numbers here are end of year. So at the end of the first year, she has put in $60,000 in this example. Access to capital is $55,000, over 90% right there, access to capital. But check this out. Look at year two. Puts in $10,000. Cash value at the end of the year, end of year two, has grown by $10,607. Now you'll see here, we're dropping the premiums down. They don't typically go up over time. They can't go up, by the way. They can only go down or stay level. They cannot go up. So at year 11, she chose to drop it down. She chose to do this, dropped it down by $3,120, and the cash value went up by $10,590. So more than 3 times what she put into this policy. And that's just going to get better and better and better as time goes on. And of course, this person can use this cash value right here during all these years without interrupting the growth of the policy. That is one of the most powerful things about infinite banking, is the just uninterrupted compounding. All right, this is a quote by Warren Buffett. I don't think Warren Buffett probably said this, but it's one I've seen out there before. But the way I would actually change this is that if poor people had the knowledge of the rich and took action on that knowledge, they wouldn't be poor anymore, or they could choose not to be that way. But anyways, that's an interesting quote there. But like, this is something that everybody always says, oh, this is only for the rich. No, it's not. It is definitely not. All right. So a little bit about me. So I've been teaching infinite banking for about 9 years so far. I've done hundreds of webinars on it and stage presentations, all that kind of stuff. Here at the Money Multiplier and the BYOB team, we have an entire team that works with you. It's not like just a couple people. We're over 30 people on our team. We are one of the largest producers of infinite banking in the United States. So I personally have, I think, 100 clients right now in underwriting. I have 50 clients right now that are approved, have policies approved, that are getting ready to start their policies. It's really exciting. So yeah. And then we also provide ongoing support and services. There's really no cost to you. We don't charge you for our services. We do have the Vault software, BYOBvault.com, that has a subscription to it, but that's if you want to go use that, you can. But yeah, so like, it doesn't not cost anything to work with us. If you want to talk to me, that kind of stuff. Another question I get quite a bit is an IUL or VUL infinite banking. No, IULs and VULs are not something that we would ever recommend for infinite banking. IULs and term insurance pay some of the highest commissions, and we do take a pretty massive cut in commissions. We do show you what they are, by the way, to do infinite banking for you, and we only do infinite banking, and we don't do other types of, like, we don't do IULs, we don't do that kind of stuff. And if you ever want to, you say, well, Brian, why not IULs? I challenge you to go do this. Go to Google and type in IULs and Kyle Busch, the NASCAR driver. He just lost $8 million to an IUL. So you can go read about that and make your own decision from there. But yeah, we do not touch IULs and that kind of stuff. One of the last slides I'll share with you here is, in life, 2 things are going to happen to us. One, we're going to live. We know that, right? And we're living right now. So are we better off with or without infinite banking in our lives? Okay. Then, of course, we know that at some point we all are going to graduate to that place up in the sky or down below, depending on who you are. But are we better off with or without infinite banking when we die, with that guaranteed tax-free death benefit? Depends on your situation, but I mean, for me, my family, absolutely. So yeah, so that's pretty much it. I'm not going to go through this thing right here. This is really quick though. This is my kind of journey to infinite banking. When I first learned about this, I was the guy on the left. I said, hey, I'm going to go do this on my own. I'm not going to work with this group over here. It was a separate group from this one, but I said, hey, I'm going to go do that. And it did not turn out very well, by the way. I was the person that did my first policy. I didn't really understand infinite banking very well at all. They gave me a bad policy, garbage policy. And it was my buddy, right? I went and worked with my buddy, which I'll never do that again. And then fast forward, once I got hooked up with the right people, the gentleman that was my mentor, by the way, then I had a real infinite banking in my life. So, definitely, I like to be in group two. So essentially, it's this. Let's hop on a call. Let's solve your problems. Let's see how infinite banking can help you accomplish your goals, overcome your challenges, and build that wealth for you. So let's just see if infinite banking is a fit for you, because I'm going to be very honest. Infinite banking is not a fit for everybody. It is not. And so if you do, hop on a call, I will tell you if it is a fit or if it is not, just being honest, because it is an absolute privilege to be able to do this, in my opinion, because I have a lot of people that, hey, health reasons or financial reasons, they can't do infinite banking and they're bummed out about it and it sucks. But if you can do this, and it's awesome. So yeah, let's hop on a call and let's see if it's a fit for you. Last slide right here. So this is the quote at the very beginning. Makes more sense now. The problem in America isn't so much what people don't know, it's what they think they know that just ain't so. So I've had a lot of people, no less than hundreds of people, that have talked to me about infinite banking that had a preconceived notion around infinite banking, watch this presentation or watch me on stage or whatever, and then they're like, oh, this is what this actually is. That's what it means. Because there's a lot of people that don't understand infinite banking that make a lot of comments about it, but in most cases, they're just not correct. All right. Well, good seeing everybody here again. With that, happy holidays, Merry Christmas, Happy New Year, and we'll see you soon.